Today we'll talk about some risk tolerance and diversification. I know we kind of covered this at like our like mini workshop 2 weeks ago, but we'll cover it again just briefly. And then we'll do like a little stock picking activity so that you can actually see, like, go along with what we're going to be talking about, the different metrics. Valuation metrics are mad boring. I'm not going to lie to you. They are like, some people really hate them, but it's like going to give you a general understanding of like when you're looking at a Yahoo Finance page, like what these terms mean, so that you can be like, oh, this stock is actually doing pretty well, or this stock kind of sucks. And then we'll go into some financial statements. I'll just point out like a couple things that can indicate if a company is doing well or not. It really won't be like too scary. And then we'll end up with some different resources that you guys can use.
Okay, so we'll first dive into risk tolerance. And what that really means is the degree of risk an investor is willing to endure given the value of investment. So how much they're okay with giving a risk. That's basically what the risk tolerance is all about. There could be types of investors here. First is the conservative investor, and then second is the aggressive investor. When we think of conservative investors, they're basically dealing with low risk tolerance. So they will most likely invest in like ETFs or mutual funds. But then when you think of aggressive investors, they are all good with having a high risk tolerance. And so they will be dealing more with like stocks and bonds. Time horizon is an investor. Time horizon an investor has can play a role in the risk tolerance. So like a younger investor may have greater returns by investing in higher assets like stocks or bonds versus like a low risk one. And then portfolio is investors, other assets play a role. Investors with more stable assets can take greater risk. So that's going to be the portfolio part of it. Here we come up to like different investment types, and the left side is basically showing the arrows, which really tells you if it's high risk or a low risk. Stocks is always gonna be like a high risk investment, and it's like ownership. You're taking an ownership of a company, so that's gonna be stocks. Then ETFs, we talked about ETFs and mutual funds are those type of investments which will have like lower risk tolerance. And then bonds is also like a type of investment which is going to have like a higher, going to have like a lower risk tolerance. And then one thing to point out here is the real estate. The real estate is really can go either way depending on the current situation and like the people who are involved with real estate. So that's one investment that could go either way. It could have a high risk or a low risk depending on your current situation in that area. And then derivatives would be a type of financial contract whose value depends on the asset's benchmark.
Great. Pointing out that this is more like in general, there are ways that you can make them more low risk. So like stocks, you have something called like a large cap stock, which just means you're thinking of like Apple and stuff like that. You're not thinking Apple's really going to go bankrupt in the near future. So they can be a little bit less risky.
Okay, so this one is going to be the diversification area. And basically what diversification is means is that you are investing into different investments. So it's not just like I'm just going and investing all my money into stocks, but I'm having like different options of investment, like cash, whether that's bond variety, stock variety, so that it's basically having more diversification will help me become, will most likely be like, it's not about lower, it's like lower risk. It's like I have more options, and like my whole money is not just like gone away just because the stock market has crashed. So I have like other ways of investment that has helped me to keep me still in the market. And then the advantages are like reduces risk, it smooths out returns, and it also helps in improving your long-term portfolios. So diversification is across the board. So it's not only the different types of companies, but also industries. So you're looking over, it's not like looking over just at the IT companies or something, but like going over different industries and picking out companies and using diversification there as well. And then the graphs, the pie charts, you're summarized it really well. So like not diversify would be just like going in and buying the stock of Apple and putting your whole money into it. That would kind of be a not diversified area. But like more diversification would be like, even if you take 3 categories, but you're still investing in different parts or different industries to increase your diversification, increase your like lowering your risk tolerance. And then these are the types of companies. They're usually divided into public companies and then private companies. The public companies are basically where the stock exchanges will happen, or they're investing their money in stocks, most likely to expand their industry. That's how the public industries work. And they are like bounded by the standards of the SEC, which is the Securities and Exchange Commission. So they have to send in their quarterly file reports to the SEC as a part of their rules and regulations. Compared to private companies, the private companies are still giving out stocks, but like they don't have to file a report, like a quarterly report to SEC. They're not bounded by those SEC regulations. And also like when they are private companies have other ways to expand their businesses and their territories, and stocks are not, like investing is not one thing of it. So they will invest a little bit, but like that's not their primary way of expanding their territories.
One point I also want to make is that when we're looking at these public companies, the SEC is like overseeing them. So they're making sure that they're giving you financial statements that are true with good estimates so that you can make like reasonable decisions as investors. They've had like some public companies like Enron who've had like financial scandals and like cheating, but the SEC regularly like checks and audits those statements.
Awesome. So we're gonna do like the follow along and like activity. So we're going to each choose a publicly traded stock. So like kind of whatever you're interested in. So maybe you're like different, like a clothing brand, like maybe you're interested in that, or like Apple or something. So take time to think what type of company you want to look for and go on Yahoo Finance and like see if they're public or private, depending on like which company you choose, and just pull up all that fun information.
You'll head over to Yahoo Finance. So for us, we'll do Apple. But you guys can pick whatever one you want. You guys have your computers out. So this is kind of what it's going to look like. I know it's a little bit intimidating, but you don't have to do Apple. Just pick a different one and just have this on while we go through the presentation. Is everyone able to get onto it? What are some stocks that we chose?
Big Target.
Target, that's a good one. Can think of big corporations. Nike,
Yeah.
Okay, good. We got any Adidas? No. Disney, yeah. Abercrombie, yeah. Alrighty. Thumbs up if we have our stocks. Okay. Awesome. Let's continue.
Cool. So this slide kind of just covers the basics. So the ticker symbol, which is an abbreviation used to uniquely identify a publicly traded company, like in particular. So like all like the short random names, like they're all just like, they all like follow like a pattern. So they're recognizable like in the stock industry when trading. So it's just an abbreviation. And then dividends, which are a distribution of a company's earnings to its shareholders. So if you were at the workshop last night, it's like, you know, you're cutting a little sliver piece of the pie with how many stocks you buy, how many shares of a company you buy. And then at the end, they'll probably give you some. So if you like, you can see it on Yahoo Finance, if you wanna show that.
So here we've got our ticker symbol, APPL for Apple. Sometimes they're a little random. And then here you'll be able to see if they offer dividends, which just means that they're like, they get money. They have like, oh, we have this extra money, so we'll just give it to our shareholders. Sometimes it's a good thing, sometimes it's a bad thing, but usually like if you're investing it, they'll give it to you by the X dividend date. So like August 5th, 2022 is when you'll get those dividends in your account, no matter like how the stock's performing. Any questions on these?
If it says like NA, does that mean they just don't?
They don't offer stocks. So not all companies offer stocks. Sorry, dividends. They offer stocks. Not all companies offer dividends. It just depends whether they want to use those like retained earnings. So those are like, that's like their extra money left over to give it back to their shareholders, which is you guys, or to invest it back into their company through like research and development, other stuff like that. Okay, ready to move on? Yo, this part, stay with me now. This part might suck a little bit, but we'll get through it, okay? Alrighty. So we'll start with a price to earnings ratio, which just means a company's share price over a company's earnings. And a high price to earnings ratio will tell you that a stock is overvalued or investors are expecting high growth rates in the future. Now, all of these are going to be compared to similar companies in the industry. So let's say Apple versus what's a similar company to Apple that we can think of? Yeah, Microsoft, Google, so like those big companies, right? They're going to have other price to earnings ratios. So we're going to compare the other two. And if Apple's is like, let's say it's 30 versus Google's price to earning ratio is 15, then you can say like, oh, well, it could be overvalued. And then the market thinks it's higher than it actually is worth. And then companies that have no earnings or losing money don't have that ratio because they don't put it under the denominator. Earnings per share. So we know what share price is and we know what earnings price is. Just multiply them. Divide them. So company's profit divided by the outstanding shares of common stock. So outstanding shares just means how many shares they're issuing to other people, like 1,000,000, 200,000, stuff like that. And it indicates how much money a company makes for each share of its stock. So a higher earnings per share indicates greater value because investors will pay more for shares if they think the company has higher profits relative to a share price. So an earnings per share, better if it's higher, right? All in comparison to the other stocks. Now remember how we talked about dividend yields? So here's a dividend yield percentage. So how much company pays out dividends each year relative to its stock price. So let's say their stock price is $100 and they're paying $1 dividends. Well, that's 1% of a dividend yield, right? Sometimes you could aim for around like 5%. That means it's a pretty good dividend yield. And it just means you're getting a little bit more bang for your buck. So if we take a look at Apple, we got PE, EPS. So Apple has their price to earnings ratio right over here, 24.29. And their earnings per share is 6. This kind of makes sense. Dividend yield percentage, I think, would be in statistics, but I can't be sure. Yeah, here we go. So a lot more ratios over here. You can head into statistics and you can check what their dividend, the date payout is, what their yield percentage is. So 0.61. So they're not paying a lot of dividends based on their share price. I'll stop here to see if anyone has any questions. Go ahead.
How do you know when the PE ratio is just the stock being overvalued versus the expect or the investors expecting it to be like higher growth rates? If that makes sense.
So a lot of the times, like, it's stuff that you infer or that the company tells you. So they'll issue their like annual reports, and you can see, are they doing any cool things
Mhm.
that perhaps mean that investors are going to expect higher growth rates?
Yeah.
What's in the news? Are they launching like new fun products?
Mhm.
Versus if you're looking at Apple right now, well, are they like launching any cool new products? Like not really. I don't know if they're doing any recent launches. So if it's going to be really high, then you're like, oh, it's probably overvalued because there's so much hype around it. Does that kind of make sense?
Yeah, no, that makes sense.
Mhm.
And also, is there like a good PE ratio? Like, is there something you search for right now?
I wouldn't say so. I would say when we're looking at that PE ratio, we're going to compare it to companies that are similar in that industry. So let's say like, I don't know if Lululemon's a publicly traded stock, Lululemon, we're going to compare it to Athleta,
Mhm.
and we're going to see like, oh, which one is kind of higher and like what's the average almost. Any other question? Yeah.
Are dividends the only form of like profit from stocks, or is that like in addition to, let's say, if the stock price goes up and then you like liquidate it? Or like is dividends a part of that, or is that different?
It's different. So dividends are kind of like the icing on top almost. So if you're buying a stock and I buy it for $50 and I sell it for $100, I get that $50 profit. And then dividends is that extra thing that they're like, oh, quarterly, because we're doing so well, we're going to pay you $2 extra this quarter, $2 extra this quarter, because you're holding that stock. And when you sell it, then you don't get any more dividends because you don't have a share anymore. Great question. Go ahead.
That percent, like the dividend yield is like the percent of how much you paid for it, or what is that?
The dividend yield percentage. So the dividend yield percentage is like how much dividends they're paying you in relation to their stock price. So if their stock price is $100, it's just comparing that how much dividends to how much the stock price is. All good. Yahoo Finance has like all weird ads. Any other question? Yeah, go ahead.
So when they like declare that they're gonna pay dividends, do they go off of like the current stock price or the price you bought it?
For the dividend yield percentage?
Yeah.
That's a good question. I think stock price, but I could be wrong. Because they actually, I'll look into that, but I'm gonna say it's current, but I'll research it and see. All right. So now we'll head into some more valuation metrics. So we have our debt to equity ratio, which is a company's liabilities. Liabilities just mean like how much debt they have, like they take out loans, stuff like that, over its shareholder equity. So that's like when we think of equity, we're thinking of how much stocks they're issuing. So they can finance their operations in two different ways. They can finance it through getting loans from the bank, or they can finance it from getting loans through shareholders. So it's just how much, like comparing how much debt to equity they have. And it's a degree to which a company is financing its operations, right? A higher debt to equity ratio will suggest that they're more risky, while a low one may indicate that a business is not taking advantage of debt financing to expand. Again, this is in comparison to other companies within the industry, but when you're thinking of that debt, that means like, oh, they're taking out more loans in the bank versus they're not taking out like any loans in the bank. Does that kind of make sense? Then the price to book ratio compares the company's market value to its book value. And then return on equity measures net income divided by shareholders' equity. So price to book ratio gives you a reality check almost. For investors seeking growth at a reasonable price, and it's often looked at in conjunction with ROE. So these two, that's why they're together. A reliable growth indicator. So large discrepancies between the two can send a red flag to those companies. And overvalued stocks frequently show a combination of a low return on equity, so how much equity you're getting back, and a high price to book ratio. But if it always growing, price to book ratio should all be growing. So these should be like kind of in conjunction to each other. And when we're looking at, let's say, Apple, you have that summary. Actually. So return on assets, return on equity, ROE, here we go. And then where's the book? Should be somewhere around here. Yeah, total debt to equity ratio, that's where we can find that. And then book value. Should be somewhere around here. Any questions on these? Alrighty. So then we'll cover two more. These aren't like, you don't really have to know them, but they're a little bit more helpful to get a better overview of what the stock actually looks like. So an alpha is just return on investment that's not with the general movement of the market, versus beta, that's the volatility of the portfolio. So let me explain it this way, right? Your beta is basically how much the stock is moving with the market or the S&P 500, right? So like if the market is doing well and our economy is booming, then this company is doing well and it's also going to be booming. And then the alpha is like something that's like a little like extra, something else that the company is doing that's not in relation to the market, but is unique to the company. So when we're thinking of like Uber, when they were first starting out, like they're doing something that's not with the market. So that's going to be their alpha. Measure performance or has managed to beat the market return over some period. High alpha is always going to be good. Beta, it depends on your risk tolerance. So stocks with betas above 1 will tend to move more with the S&P 500 and less than 1 with less momentum. So they can only provide you an approximation. Any questions on these? I don't know. Let me check if they actually have the alpha and beta here. Yep, beta's right here. So 1.23. Who can tell me what this means?
Means it will move with the S&P.
It's above that 1, so it's going to move with the market. And then I don't think they have alpha, but there's lots of calculations to calculate alpha. Alrighty. So again, just want to stress that these are going to be compared to other companies in similar industries, and that's how we determine those. For example, Toyota compared with Ford, Honda, General Motors, Fiat, stuff like that. Okay, and now we'll take a look into financial statements. Like, remember when we were talking about the SEC and how every company issues those financial statements? Well, you can use those to determine how well that the company is doing by the company telling you themselves. And so they're written records that they can be used by government agencies, accountants, firms to gain general knowledge, and they're available on sec.gov. So it's called like an Edgar database. You would just log on to sec.gov and it would give you like this whole long list. You'd look up the stock ticker and you want to look for their income statement and their balance sheet. So your income statement will summarize their expenses and all their methods of income. So it will tell you like if they have a loss or stuff like that, what their expenses are. If they're doing any like really high expenses, you're like, that's weird, why? And then your balance sheet will report your company's assets, liabilities, and equity. So equity is that shareholder value that we were talking about, so how much they're giving out to shareholders. Assets are just how much like, like property they have, all that different stuff, cash, and liabilities, how much debt they have. Now, where you'll be able to find these is in what's called a 10K and a 10Q. They sound like tax forms almost. But a 10K just means an annual report of their income statement and balance sheet, versus a 10Q is just going to be that quarterly report. So I want to point out that 10Ks are going to be once a year. They're very in-depth, they're super long. You could just look up the income statement and the balance sheet, like you don't have to worry about the 100 other pages. It's generally audited, so that's what we talked about earlier. Someone else is going to check and make sure that their numbers are right. They have to do it within 90 days, and the 10Q is kind of the opposite, filed quarterly, fewer details, unaudited, every fiscal quarter. Questions on these? Already. So we already talked about these, but I want to kind of show you what it looked like. So when you're looking at the income statement, you're going to be like, oh, wow, they have so much money they made in revenue. That's like how much money they actually made in total. And then you're going to have to subtract those like expenses that they had to get to kind of your losses or gains, right? So here's going to be your net income. That's how much money they actually have, minus all their expenses. And then your balance sheet, like cash, inventory, property, is going to equal all of your rent and all of your retained earnings. Questions on these?
Also, if you're like ever interested, like more like the qualitative side, if you're like looking to invest in like a company, like a lot of times when you look up like the 10K and 10Q, you'll find like a recording of like someone like speaking about like what they're gonna do for their next quarter, or like what's kind of holding them back, and it gives like an overall idea of like what like cool things are the company's gonna do in the future that maybe like will increase the stock market price. So like personally, I like doing that one because there's so many numbers, and so I'll just like listen to like a guy talking about the company. So, yeah.
Oh, I didn't even know that. That's
Like, stock
interesting.
pitches, yeah. It's like,
Huh. And then when you're looking at publicly available financial statements, like a lot of the times they're going to have some really hard like accounting terms. So don't let that scare you. If you're really interested, you can always look at like copy paste, and they have like better definitions of those. So don't let the accounting terms scare you.
oh. Yeah, so other considerations, so annual reports, like that voice recording will be there, and like just a bunch of information about the company and what it looked like that year. Board of directors of report, sustainability or ESG reports, which is really interesting, and like seeing where they're going with that. Recent news, like sometimes like throughout the week, I'll try to like, read Wall Street Journal and like just like see what's kind of happening with the market and like what's happening with like big companies. And just like your personal experience, especially right now, it's like we're going through a recession. So like, kind of using what you see every day and like what you hear, like that's always valid information. And then some notes on taxes. So capital gains and losses are classified as long-term if the asset was held for more than 1 year. And short-term if it's held for a year or less. So short-term capital gains are taxed ordinary income as rates go up 37%. Long-term gains are taxed at lower rates up to like 20%.
Yeah, so typically if you're like a longer term investor, you have less riskier stocks, and then you like hold it for a longer amount of time so that you can tax it at a less percentage, which is a life hack. So we saw that example with Apple stock. But do we have any like questions, or do you guys want to know like what any other stuff is over here? As you look through it.
Does the like previous close and the open, is that like in dollar amounts? Like, is that what one
Yep.
stock is? Okay.
That's gonna be, yeah, so previous close is just what it closed at the day previous. So like the stock market closes, and that's like what it ended at. And then it opened at here through like the night and like night trading, I think, from internationally. Okay, well.
And here are just some like investing platforms that a lot of people use. So, I mean, they're pretty much like, they're not like too different. Like you can't really go wrong with like any like investing platform that you're looking into. So Fidelity is great for like frequent traders and also beginner investors. It's just like super easy to understand, very low rates. Amero Edge is excellent for casual traders. So if you're not like, you know, an aggressive trader and you're like looking at it like every hour, just like you want to put your like money in and like watch it go over to like go for a long time, you know, that's something to look into. But yeah, some platforms. And then some more, so we talked about these a little bit in different, at one of like our mini meetings. And so Ellevest is great. It's like for like women specifically, like starting off, they have really, really low fees. It's just like great to start with. Just super informational. Acorns. So this is a cool platform because it'll take your spare change and rounds up your spending. So very easy to like implement, you know, got spare change, something you don't think of, and it'll do it for you. And then SoFi, very easy like diversification and rock bottom fees. And then Robinhood, you might have heard of, just like little to no cost, no fees. So yeah, these are all like, I mean, most of them you'll find they're like relatively cheap. Just so many options out there. Just like, yeah, research and see what one works best for you.
So that's most of our content today. I know it's kind of heavy, like valuation focused, and that's why we have like the, you know, personal finance, traveling on a budget, those workshops. So do you have any questions before we head out?
Feel free to like email us or like text in the group me if like, you know, you have to do something over class and you're like, wait, I don't know what this means. I forget. Yeah.
And I know that recruitment season is coming up. So we have a resume and LinkedIn workshop if you guys want to look on our website. And I'd also be happy to look over anyone's resumes or LinkedIn's and give you advice. So you can just email me. Right. Thank you guys for coming. Please take some more pizza.